Let us stand for the national anthem.
Stand and sing, O Zambia, proud and free, land of wake and joy in unity, victors in the struggle for their right. We've won freedom's fight, all one, strong and free. Africa is our own motherland, fashioned with and blessed by God's good hand. Let us all her people join as one, brothers under the sun, all one, strong and free. One land and one nation is our cry. Dignity and peace needs Zambia's sky. Like a noble eagle in its flight, Zambia, praise to thee. Oh, one, strong and free. Praise be to God. Praise be. Blessed when Zambia, free men we stand under the flag of our land. Zambia, praise to thee. Oh, one, strong and free.
We may remain standing for a prayer by Mrs. Catherine Kadeo, our assistant accountant.
Let us pray. Our God and our Father, we want to thank you for this day that you have given us for this MPC press briefing. Lord, we pray that you may be with us. We thank you for the leaders that you have given us, Lord. We pray that you may continue to grant them the wisdom, the knowledge, the understanding that they need, Almighty God, as they make decisions. We pray that you may continue to be with us so that we may continue to advance as an institution and as a nation. We just leave everything in your holy and capable hands. In Jesus' mighty name we pray. Amen.
Thank you very much, Catherine. We may be seated. Allow me to acknowledge the presence of the governor, the deputy governors, members of the Monetary Policy Committee, members of the press, ladies and gentlemen, good morning. I welcome you to our first Monetary Policy Committee press briefing for the year. As you may be aware, the Monetary Policy Committee was meeting over a 2-day period from Monday to Tuesday, and this morning the governor will be announcing the decision of the committee. Let me introduce to you the people on stage. We have the governor, who is accompanied by the deputy governor in charge of operations, Dr. Francis Chipimo. Next to Dr. Chipimo, we have Director, Bank Supervision, Mrs. Gladys Chongo Chiwele. On governor's left, we have Deputy Governor in charge of administration, Mrs. Reka Chifue Muhango. And next to Mrs. Muhango, we have Director in charge of economics, Dr. Jonathan Chipili. My name is Besnat Mwanza. I will be your master of program this morning. Without further ado, I will at this point invite the governor to address the press. Governor, sir.
Thank you very much, Bessie. The outline is as indicated on the screen. but I just want to indicate that this time around, we have made a bit of some change in the way the statement that you'll be getting momentarily is crafted. We have made every effort to make the statement speak to the message that we will be delaying, so that you can follow clearly what was going on in our closed doors to arrive at the decision that I will momentarily share. So this, we believe, is a better way of perhaps articulating the issues that surround the decision that we make. So at its meeting held as indicated yesterday and Monday, the Monetary Policy Committee decided to increase the policy rate by 25 basis points. That means that the policy rate now will be at 9.25% from 9%. You also recall that over the past year, we left the rate unchanged because of our assessment of the situation during those MPC meetings. However, at this particular meeting, we noted some very substantive changes to the environment, and that's what prompted us to take the action that we have taken. To be more precise, we found that in the projections that we make, whereas in the past, inflation was trending downwards and in fact, even getting into the target range that is of 6 to 8% in the first quarter of 2024, this time around, we noted that because of certain development which we outline, inflation is not trending in that fashion. If anything, we see that it is moving away from the target band. Although towards the end, it's coming towards the target band, but it does not quite get into the target band. Therefore, we felt that it was necessary to indicate our commitment to the undertaking that we have made and the mission of the bank to address this inflation that we are seeing. Now, the other aspect that we took into account is that on the 1st February, because of the pressures that we have observed in the foreign exchange market, we did raise the statutory reserve ratio on all deposits of commercial banks by 2.5 percentage points. I think in the circular announcing that, we did indicate what prompted us to make that decision. Now, we recognize that this measure is just taken effect. As a matter of fact, the observance of that measure began this past Monday. So this adjustment we have just announced of the 25 basis points comes on top of that. And this is one of the reasons we felt that the adjustment has to be minimal as possible to complement the area measure that we took, as its effect has yet to be fully realized. Now, the other thing that we took into account is that the financial sector is now experiencing some moderation in the vulnerabilities, and that gives us confidence that the adjustment will not adversely affect the financial sector to the extent that it becomes unstable. We also noted with the appreciation that there has been some positive growth, and the prospects in the medium term are very positive. As a matter of fact, what we kind of see at the moment is that it's like you are at a cliffhanger where certain thing, if you cross it, you are going to be in an area which is conducive for business. So, but for us to get there in a manner that enables us to fully take advantage of those benefits, we have to continually address our macroeconomic situation. So positive growth in the medium term is very, very promising. Now, we note too that there has been progress made in the implementation of what we term much needed fiscal reforms for macroeconomic stability as sustainable growth. We'll highlight some of these in the presentation as I go on. So in short, we did raise the policy rate by 25 basis points to take account or to address the emerging pressures that we have seen on inflation stemming from the foreign exchange market. Now, inflation outturn obviously has been very positive. What we note is that inflation had continued to decline for actually 3 quarters in a row. You see this table here, where if you go to Q2 2022, inflation for the quarter was 10.5. It came down to 9.9 in the third quarter, and in the just past quarter, it was at 9.8. So the trend is very encouraging. As a matter of fact, in January, inflation went down further to 9.4%. But as I said, when we project this over the horizon that we forecast, which is 8 quarters, we see that that trend is being reversed. And that's what is prompting us to take the action that we are taking. So the first part of this table obviously talks of the average, and in the second part, it talks of the end period, that is the month for the end of that particular quarter. So you can see what has been happening there as well. Factors driving that, I think you have seen in the chart already, is both food and non-food. Although in the period that we are just looking, the food increased by 12.1% from 11.8%, but the decline in the growth of prices for non-food were such that they pulled down the overall inflation for the period. As I said, in January, inflation went down further. Outlook, which is the main anchor for the decision that we have made, shows that over the forecast horizon, inflation is projected to increase and remain above the target range of 6 to 8%. This is in sharp contrast to the earlier projection in November 2022 that showed inflation would return to the target range in the first quarter of 2024. Inflation is now projected to average 11.1% in 2023, and compared, to the November forecast of 8.5. You can see that's quite a big change. And in 2024, inflation is forecast to average around 10.1%, which is above the target range as indicated. The factors that underpinned or underlie our forecast were the recent depreciation in the kwacha against the dollar, the anticipated increase in electricity tariffs to cost-reflective levels, and the possible reduction in maize production due to, among other things, adverse weather conditions and crop infestation by 4 armyworms. So when we put this in our forecasting model, they showed that inflation was going to be going up. Further, the continued tightening in global financial conditions and negative sentiments arising from the protracted debt restructuring negotiations working through the exchange rate channel are expected to add to inflation pressures. The foregoing factors remain potential upside risks to inflation as well, because if this continues beyond that is expected, obviously it will have those adverse effects which we are seeing. So what we observe in the foreign exchange market is that after a cumulative appreciation of 10% in the previous 2 quarters, the kwacha depreciated by 4.3% against the dollar to an average of 16 kwacha 71 were in the 4th quarter of 2022. So this chart on the right side just shows that development. So the movement is what you see the upper part of this chart, the red above. That's what we are referring to. You see that it had come down and then it's moving back up, and it's moving at a fast rate, which, as we indicate, the depreciating trend has persisted in 2023, with the kwacha trading at 19 kwacha 33 ngwe per US dollar as of yesterday. Low foreign exchange supply, particularly from the mining sector, as you note from the chart here, explain much of this development. You can see the change there. If you look at the blue line, the blue shaded part there, that reflects the mineral royalty taxes that were remitted to the bank, and the orange part shows the other taxes that were also remitted to the bank. You can see that from Q2 2022, which really was the peak, since then there has been declining supply of foreign exchange, both in terms of mineral royalties and other taxes. So this is happening at the time when demand is rising for some of the things that we need. Now, for us here to try and address this, we had to, firstly, I did make reference to the raising of the statutory reserve ratio, but in addition to that, we were providing the foreign exchange we were receiving from the mines to the market to meet critical imports of agricultural inputs, as well as petroleum products. As you know, this is one of the ongoing importation that we make. So in that regard, we did offload or provided market support of up to $443.5 million during the quarter. This shows an increase from the $333.5 million that we provided in the previous quarter. So you can see that this is quite some big support along with other supplies. But what we have observed too is that in the past, we had these foreign financials who come to participate in our domestic bonds and treasury bills. They used to bring in some dollars into the market, which would help to augment the supply of dollars. This time around, what we are seeing is that they are coming on the demand side more than on the supply side. Now, one of the underlying factors to that is this delayed restructuring exercise which is going on. But quite apart from the delay itself, there is this pressure to loop in the non-domestic holders of domestic debt into that. So what that is doing is that those who would like to come into the market are scared to do so for fear that if they did, this may be part of the restructuring exercise. Then doesn't end there. Those who are in are also not renewing their investments in our treasury bills. So when they mature, some of those are opting to cash in that maturity. Even those who get a coupon interest rate, sometimes also they don't apply that to getting new bills. So this is one of the things I think we have been talking about, that we need to quickly get some determination on this matter. We have made very strong representations on this matter to the committee that is looking at this issue, but they have yet to pronounce themselves on whether this is not going to be included or not. But in the meantime, it is having this adverse effect on our market. So that coming on the back of reduced supply from the traditional source adds the pressure that we are referring to. The other thing is that the divesting that is happening is informed also by what is happening in the bigger economies. You have seen the US, for example, Europe, they have been tightening their monetary policy, and in so doing, the financial conditions have been tightening. But beyond that, for countries like ours, also suffer another impact, which is the reversal of these flows. Because the feeling by investors is that those markets are deeper and obviously they are more secure than our markets. So that's the principle or the classic case of capital reversals or portfolio reversals that we talk about. So all these combined are adding the pressure that we are seeing in the market. Our gross international reserves, however, remained steady at $3.1 billion. Now, another interesting aspect of that is that when we convert this to months of import cover, you find that actually this covers more imports than the previous period. This is simply because the figure of imports that is being used to arrive at that number has come down, and we use the prospective imports. So it is showing that the prospective imports have come down, and therefore the months of import cover has gone up for the same amount of reserves. So this is just to show you where it has been all this time, and it has remained steady, as we said. Then on the current account, we see another development which is affecting the foreign exchange market, that the current account, which had recently been robust, has now weakened with adverse implications on the foreign exchange market. Preliminary data that we have shows that there is a sharp decline in the current account surplus to $10.3 million in the fourth quarter from $24.5 million in the previous quarter. The revision to the current account for the third quarter of 2023 mainly reflects changes in the trade balance following an update to export earnings. This was largely driven by significant reduction in net merchandise exports and an expansion in services account deficit. But we see that in the medium term, the current account is projected to rebound. So this is where, again, we are urging that we should apply every effort to get exports diversified, for one, and also increased. So this is what the current account picture looks like, which I just referred to. What this is pointing to is that there is an expectation that there will be increased export volumes of copper in the period ahead. So we hope that holds, and once it does, even that other chart I showed you will show something different in the period ahead. Then the other area we thought we should highlight, this is one dealing with interest rates, credit, money supply, and economic activity. What basically we are seeing here is that there has been a growth in credit, in particular to the private sector. We see that credit overall grew to 18.7% year on year, and 10.1 percentage points of that came from the private sector. That's the blue shading that you see on the chart on the right-hand side. Now, the expansion in the private lending also contributed to the strong growth or stronger growth in money supply. You recall in our previous meetings, we used to say that the money supply is not growing as fast, but this time around, we see that money supply has grown quite appreciably, 24% from 13.3% in September. Now, why are we bringing this up? But maybe before I answer that question, let me look to another variable, which is the lending rates. What we are seeing here, that the average lending rate has been stuck somewhere around 25%. That's the red line on the chart on the right there you are seeing. That is, you can see it's relatively flat. Now, this is in spite of the decline in inflation that we referred to, and I think this is a matter of public concern, and we have been putting pressure on that. But I'll come back to see how this relates to what we have done, because you may say, well, your action is actually to make this even go the other side. But we have an answer for that. We also note that according to the publications that we normally use, the economic activity in the quarter under review moderated, meaning that whereas in the previous quarters we had seen some kind of sluggish, but in this particular quarter there was some moderate growth that we do, or moderate economic activity. However, putting that aside, we see that in the medium term, which is what I stated at the beginning, we see some rebound in growth, and this is projected to come from mining, agriculture, and the construction sectors, as well as the traditional drivers of this growth, which are financial and insurance, information and communications, wholesale and retail trade sectors. So these have been the sectors which have been driving growth all along. But in addition to those, we see that mining, agriculture, and construction sectors would add to that growth. That's in the medium term. That's why we are saying that we need to stay the course so that that does indeed happen. Now, the question is that what does this do? What action we have undertaken mean for this? What we are saying is that if we do not make the adjustment, these positive changes that we are seeing will be short-lived, because once inflation kicks in and the exchange rate continues to depreciate, there will be some unraveling of things in the economy. And this is what we want to hold in check. Now, in arriving at this, we obviously had to take a very close look at this. And in our view, we had to take a very delicate balance, or straight a delicate balance. What do you mean by that? What we are saying is that the choice was, do we take this action or not? In our assessment, we felt that taking this action was necessary, because if we did not do so, the changes in the exchange rate and their impact on inflation would actually make these very variables vulnerable, and macroeconomic stability in general would also be at stake. So this is the balance that we had to strike, and also the calibration of the rate to 25 basis points was deliberate, because that is to signal, but at the same time also take, in combination with the increase in the statutory reserve ratio, some restraint on the growth of inflation and the depreciation in the exchange rate. So this is the rationale behind this action amidst these other positive developments. The other area we looked at was the fiscal policy. What we see here that the preliminary data indicated further reduction in the cash fiscal deficit in 2022 to 8.1% of GDP from 9% in 2021. So this trend is very important. The deficit is in fact projected to continue on a declining trend to 2023-2025 due to expected improvement in revenue performance, improved fiscal management, underpinned by expedited external debt resolution, the debt restructuring that I was referring to, and essential structural reforms that are being undertaken, particularly in energy, agriculture, health, and the education sectors. The measures that we have taken, that is the raising of the policy rate and the increase in the statutory reserve ratio, are meant to actually support these in due course. In the immediate, you may find that they may appear to be actually slowing or pointing in the different direction. The point you want to make is that when you are on a journey, as we are, and you are on a difficult journey, that at times you have to pause and check where you're going, especially if the road is bumpy. You may have to take a detour to be able to make the progress that is necessary. Sometimes you may have to reverse, but that doesn't mean that you are not going to your destination, but it's just that you want to be able to move in a manner that enables you to reach there. Because as they say, speed kills, although others will say that it's not that speed that kills, but a sudden stop. We have not stopped, things are moving, but we need to navigate this bumpy point that we have reached in our reform process. So in the end, the idea is that all these must be pulling together so that we have macroeconomic stability and the growth that we need that is inclusive and sustainable. Conclusion. What we are saying here is that we decided to raise the monetary policy rate by 25 basis points to 9.25%. The decision was underpinned by a projection that inflation is moving away from the target. You notice in our statements, we have that standing statement that we remain ready to take action if the observed inflation is not in line, projected inflation also is moving differently, and the risks that we see. So this is where we are. We have seen that the projection is pointing in another way, but we need to get to the target range as set by the Ministry of Finance. So this is, in a nutshell, what underpins our decision. We took account of all these other things that are happening around us, and we felt that it was necessary to take this signal decision at this point, because we need to arrest one of the variables or two that are threatening to undermine our macro stability. I thank you and God bless you.
Thank you very much, Governor, for that presentation. So there you have it. The MPR has been increased from 9% to 9.25%. So we are going to go for the question and answer session. We'll take 3 questions at a time. The first 3 will be taken from the audience that is in this auditorium, and the next 3 will come from our online audience, if there are any. So for those that are here, if you have a question, please raise your hand and the microphone will be passed on to you. For those that are following us through online platforms, please, you may post your questions on our social media platforms, Twitter and the Bank of Zambia Facebook page. State your name and also the media house that you represent if you have a question. Who will be the first to go?
Taonga Mitimingi from Bloomberg. The latest statistics fortnightly shows a dramatic reduction in the Bank of Zambia's claims on government in January, where at a point the claims were even negative. What are the main factors driving this situation? Thank you.
Next.
My name is Cecilia Chiluba from Money FM. I have 3 questions. Does the central bank see record profits in the banking sector driven by bond trading as opposed to lending as a threat to the social fabric of the nation, as it seems to be stimulating economic inequality more than of broad-based inclusive growth, especially given that this was supported by Bank of Zambia refinancing credit lines? Since the last meeting, we have seen the US dollar get stronger by 16% and the Kwacha enter its second longest losing streak on record since 2006, or 92 consecutive days, even within the face of the central bank selling dollars into the market. Is the central bank this time more supportive of calls from market players for open market FX derivatives, contract market, as opposed to current system of spot trading and highly expensive bank forwards? The last question. Given that our recent round of load shedding was pushed by a fast-growing domestic sector that desperately needs alternative energy, such as household solar, affordable and easily accessible finance to install such systems, what tools does the central bank have at its disposal to support lower interest green electricity loans for the domestic sector to help electricity not be a hindrance to economic growth? Thank you.
Thank you. Considering that we have a number of questions there from Cecilia, Governor, maybe I would propose that you take those before we take the next question.
I think I'll ask Dijo to shed light on why our claims on government have gone down instead of going down. I think one of the things you must know is that there is a 15% window for government to borrow. The 15% is of previous year's revenue, but this was above for some time, but maybe Dijo can help shed more light on that.
Thank you very much, Governor, and thank you, Taongo, for the question. I think there are basically 2 issues. We may have to get back to you on just to confirm some other numbers, but essentially this relates partly to the SDR accounting in the central bank. Prior to last year, we are, as a Bank of Zambia, the agent of the government to the IMF, but the funds which are drawn from the IMF are government's money, and we had an accounting arrangement where we would have the relationship with the IMF, and then we would reflect this relationship or the asset of the government in our books. I think following a mission of the IMF in terms of our safeguard arrangements, they had one of the discussions which came about was to have a much clearer definition of how that relationship is and to reflect those funds more directly as being owned by the government. And so in making those adjustments, this is one of the implications that in the net claims table itself, we're now mapping some of those funds directly into the government. I think there were also some funds received from the World Bank towards the end of the year, which again had typically been kept in dollars and not mapped to the net claims position, but those were converted into kwacha, which was given to the government, and those were also mapped. But we can provide a more detailed clarification to you on a bilateral basis, because the accounting was quite complex. And as I said, one of the issues which came up from the IMF diagnostic mission was to say you need to show this relationship in a clearer way. What is clear from the two periods, 2022 and 2021, of course, the banks have posted very significant rise in profits. And what we see from that is that, for example, I think over 50% or just over 50% of that is coming from investment in government securities. Now, we've been very clear with the banks that at the end of the day, the financial sector has to support the real economy if we are going to grow. And part of the big investment in government securities, as you were sort of inferred in the question, had come, yes, during the COVID period, where essentially risks were heightened, banks were really pulling back from lending. And the efforts that the Bank of Zambia has made was to say that, look, we must make sure that the financial sector is protected and that the banks can also support firms out there. And the message which we are giving is this, is that the structural reforms which the government is taking, already we've seen a significant reduction in the yield rates on government securities. The governor was just talking about the importance of the structural reforms being made, deficits coming down and yield rates coming down. And we have a precedence for this. In 2006-07, after HIPIC, we saw a collapse in government yield rates. And what we are telling the commercial banks is that this reliance on government profits is actually a risk. And this is an active engagement we are having with them, because the progress which the government is making, these yield rates will collapse. And then the banks will have to come back to businesses and individuals to make money. And so this is it's a very important issue which we recognize, and it's a very significant conversation which we are having with the banks.
Thank you. There was something also you mentioned about our own facility, which we provided. I suppose you are referring to the targeted medium-term refinancing facility. That facility was for a specific purpose. I think you will see that COVID-19, the pandemic, was unprecedented. So globally, all countries, authorities were making frantic efforts to support their own economies and the people. So in Zambia, we stepped up to that because we didn't want the financial sector to actually be destabilized, which potential was there. So what that facility was meant to do was to smoothen the players in the economy who were adversely affected by COVID-19 pandemic. And it did indeed serve that purpose. There are quite a number of businesses which were saved. If we didn't have that, probably the story would have been different, would have been talking something. Another thing I must stress here, when we talk of financial stability, I think we take it lightly that, well, it's there. You see, when you wake up, you go to your bank, you can get money, you can do that. Believe you me, if there is financial instability, there are some other countries which have had that. You can't have that. You go to your bank, there's no money. You can't transact, you can't, your child is at school, your brother, your sister, you can't send any money. That kind of instability is actually debilitating. So stability of the financial system is extremely important. Even these measures that we take, they work through the financial system. Us as a central bank, we are not in direct contact with the agents out there. As a matter of fact, the bank is a banker to government and commercial banks, not individuals or companies. those are facilitated by the financial institutions that include the banks. So the banks get your deposit and lend them to those who need that. So this is critically important. So that facility has run its course. It is saved. Now we are looking what else can be done, but not that particular one. Now, the idea is to work with financial institutions so that we can reduce the cost of money, as you have alluded to. You will note that that facility was being offered at the policy rate and for a longer period of time. Now, having run its course, we are looking at other ways how do the market get supported. So one of the things we have is that we have a small amount of money which we want to partner with those institutions that are engaged in this activity. But it's quite slow here. Yesterday, in fact, we are even talking to IFC, who are willing to move in to provide a lot of resources. Under the IDA, which is the International Development Agency, there is a $2.5 billion which is set aside for private sector. That money is also part of it is available to Zambia, but it will only become available if there are players in our market who are willing to go for that. But we see a bit of reluctance to take on that. There are other institutions also which are willing to partner with our institution. So that's in a way to answer part of your other question, which you said, the bank doing that. Directly, we don't do that because, you see, the money that we inject is what we call primary money. You know, that primary money has inflationary effect because it's money which is provided without the counterpart coming in. So if it is given out willy-nilly, then you are going to have an inflationary situation. So the policy rate we are talking about here is a mechanism by which we provide liquidity to the banks at that 9.25% rate that we are referring to. Now, you can already see that the 9 or even now the 9.25, looking where inflation is and look at the lending rate at 25%, the margin is still quite wide. So the reason why that gap exists is there are many factors that are at play. So our efforts is to try and narrow that through our actions. But we are doing other non-monetary things. We have these financial redress programs. We advertise the different interest rates that different institutions offer. This is in the hope that the public would take advantage of that information to bring pressure on their banks or financial institution so that there is some competition. But oftentimes you tend to be just takers of that, and then we don't see that happening. So part of the reason why we undertake financial literacy is really to make people aware of this and be able to exercise their right. In our setting here, the bank may be, or financial is ill treating you, but you complain to somebody, not even complaining to the bank. And yet you see in the bank, there are complaint officers, resolution officers, who should receive those complaints. And our colleagues, when they go for supervision, they look at those logs to see that what are the complaints being lodged by the members of the public. But it's a process. It is not something that can happen overnight. Then you raised the issue of the foreign exchange market, spot versus forward buy derivatives. You know, the core that we hear from some of the public, the private sector in particular, is that you see, there's nothing, we are in a liberalized environment which stops any of those to strike deals with their banks or financial institutions. But what tends to happen is that they want the counterparty to be the Bank of Zambia, which means that the risk one is to rest with us. Now, as an institution, we are not in active business as they are. So you can very well imagine, why would the Bank of Zambia, using public resources, anchor and private profit-driven motivation? I think you can see, you raise the first question of the morality of it, of if they are making profits. Now imagine the central bank comes out and said, yeah, you go out, you strike a deal, then you come and say, okay, guarantee me that I pay you even if that deal goes bad. That's why there is insurance. We don't use much of it. So go to the insurance. They will do that. That's the hedging. But the typical proposition is that let the Bank of Zambia be the counterparty which takes the risks, and you as the private sector player, you are risk-free. That's not very prudent, is it? Actually, you come down to us and say, no, how could you do that? So that's those who are asking you those questions, ask them, what financial institutions have they approached? Yes, in other jurisdictions, this happened, the forward market, but that is an arrangement between the parties. We have seen even banks coming, wanting to be counterparties to us. So, but why don't you engage with the others to do this? So this is one of the challenges which is there. And we are able and willing to discuss this in greater detail so that we can pinpoint some of these. But as things are, nothing stops anybody to engage in forward or derivative operation. But once you also go into derivative, though, we have to see if it's a bank which is involved, it has to spell out what risks they are facing, because if they do face challenges and it's a systemic institution, it has the potential to undermine the stability of the entire system. So we take interest in that. So stability of the financial system is our core mandate, and along with price stability. I hope we have cleared your questions.
Maybe Frida, you can talk a bit about the green electricity loans. I know we have been working on green guidelines. Perhaps you can just say a bit about what we're trying to do in that area, because it's a very important area.
Thank you very much, and thank you, DG. Yes, I think the point that was raised by Cecilia is very valid, because we have seen the impact of climate change and environment generally in Zambia. We've already begun to see recently even things like flash floods. At what impact does that have on the community and the populace at large? So what the bank has been doing, firstly, we've been building capacity to see how can the bank contribute towards enabling financial institutions to give appropriate credit, especially to promote the green finance agenda. So we're actually working on green finance loan guidelines. We've had a lot of engagements with other institutions, such as the Alliance of Financial Inclusion, including with other bilateral, multilateral institutions, such as the World Bank, Financial Sector Deepening Africa. So we're working on extensive directions to the financial institutions to see how we can promote, to enable them, provide credit which will help institutions which are going into the green sector. I think that is what I can say for now. Thank you.
Thank you. We can take one more before we pick questions from our online audience. I think we can have Mr. Mwewa.
My first question is around the exchange rate. We monitored, obviously, the Bank of Zambia's interventions last year. Now, in light of what has happened now, do you see a situation where the quantum of intervention will be the same, considering that now it's becoming a very delicate balancing act regarding mining receipts and other forex income? Furthermore, what would you say, following this announcement, what would you say is the projected GDP for this year, and whether you anticipate that there will be a revision, and do you see, and how do you see the mining receipts playing a part over the near term, if, as you had indicated, that there is some improvement, and whether there are considerations that maybe mining receipts should actually be banked domestically as opposed to them going out? Thank you.
Thank you. We can get another set.
My name is Prudence Chota from Kamne TV. Governor, let me rewind you back to 2019 when a similar situation was happening in the country. You made a similar decision like what you've done now, where the statutory reserve ratio was increased. And of course, that led to the increase in the policy rate. And the results are something we don't want to go back to. We saw a country go into recession in 2020 to negative 2.3, if I get it correctly. And then when we have a similar challenge, you've taken the same step this year. Let me also drive you back to the second quarter of 2022, where you mentioned that the private sector credit rating was downgraded. And then the decision you've taken now to today, don't you think the private sector might actually see some businesses begin to close due to the measures that you've put in place? Because I know tightening the monetary policy as well as the statutory reserve ratio has already squeezed enough for the private sector. They've got no room to breathe. But I heard when you were making an announcement, you said you did an assessment on the banking sector and you're assured that they'll not be affected by this. So don't you think there's going to be an aspect of some private companies actually closing? And then also, let me borrow from the president's words to say they want an economy that is private sector led. How do the private sector lead if at all they are being squeezed in all angles? And then my last question is with regards to the COVID-19 fund, the measures, the financing that was given, I think 10.4 billion, if I cannot get it correctly, but I know that funding was there. Can we get an update? I think I called the bank on Monday. I was told that I should go through the last record, which was given in September. I couldn't find that. The last record I found was for June, and it indicated that 73% of those resources had actually been accessed. What is happening with the remaining balance of those resources? And from those who've benefited from these resources, is there a probability that they've started paying back, or have they started paying back? Not even a probability. Thank you so much.
Thank you, Prudence. I think those were quite a number of questions. Governor, I'll request that you respond to them before we take 3 from the online audience.
Thank you very much. I think what we are saying is that you are actually underscoring the point you are making, which is that there is reduced quantum of supply. Now, a number of times, there is a lot of focus on the mineral royalty and other taxes which come through us, which, as I showed on the screen there, this has been coming down very significantly. Now, we make decisions on how to use, and so far, what we have been doing is to make that available to the market. Now, other players have said, no, you should just have let this money go to the market directly. That way we wouldn't have some of the problems. But take a step back and look. What are we really saying? Which is the other part you raised. The mineral royalty is about 10%. Then when you add other taxes, maybe it comes to about 24-25% of the total. So now we are fighting over 25. What about the 75%? No one wants even to talk about, right? So this is like typical us We fight over plots, others are taking farms. I think that has to change. So the point you are making about banking locally, we had that debate, but all we are asking, which is what is in our work plan, is the e-balance of payment project, wherein we want to have we want to know if you export, irrespective of whether you're a mine or you're not a mining company, if you export, we want to know what happens, what do you get? Because you get conflicting reports. On one hand, you as exporter, you declare a certain amount that I've exported. The importer, the other side, also reports that, and the two are not matching. Now, when we look at balance of payment statistics, you see a huge figure on other items net, simply because we cannot allocate that difference. Because you see, balance of payment, like any book keeping arrangement, is a double entry arrangement. For every debit, there is a credit. So it's supposed to balance, right? That's an identity. So now when we do that, we find that we can't allocate a certain portion. So it is put into a category called other items net. Now you can't have other items net being the bigger item on your accounts. Even if you are running a company and you find that the unexplained items are bigger, I think you should get concerned, isn't it? Because something is going on which you don't quite know. So this is what we are trying along the lines of, but not so much to force anyone to do it, but we just want information to know if you export, what have you got? What did you use it for? So that's what we are working on, and we are engaging with the private sector through the PPDF forum. That's where we'll be taking this, so that we have a good understanding, all of us, what it is that we are doing. Others have jumped to the conclusion that no, you want to reintroduce exchange control. Far from it. Any economy, even any free economy, you have to have information to be able to plan. If you don't have that information, how can? Then you hear the next time someone would say there are these flaws. How do you curb that if you don't have a system to do that? So your concern is our concern, to find more information on what is going on. But beyond that, I think if you look at non-traditional exports, which is away from the mines, they are not growing. If you look at the proportion of total earnings, they only go up when copper earnings come down, which is not very satisfactory. So one of the things we are saying is can we promote exports of different things? That way, the supply of foreign exchange will increase, and you won't be worried. When you look at, they say that, oh, what is the point? I'll get the money. Now, what happens is that when the exchange rate depreciates, those who have ideas of buying, because we have also the taste for the foreign goods, no, now it will be coming. So you go, even when you didn't need to do that at that time, and that adds pressure to the little that is there. So this is the challenge we are dealing with. This is why we want also debt restructuring to work. Because once debt restructuring works, then investors will be free to come in and play a part in this. So this is what we are saying. So we're on the same wavelength. We may be using different tools, but the free system that we have, which we have had for over 30 years now, is a system which was carefully arrived at after having tried all other mechanisms. We used to have queues. You see a queue forming, just join it. You don't have to ask any questions, because if you ask questions, they will toss you off the line and you will lose your point and you will not get anything. But sometimes you find that at the end is not what you are looking for, but it's something else. But you have spent the whole day waiting in the queue. In the bank here, one of the largest departments was the foreign exchange management system, where every Friday people sat around the table and decided, oh, who should get foreign exchange? Is it Mr. Mwewa? No, I don't like Mr. Mwewa the way he talks, so don't give him. Oh, he's a good guy, give him. We used to flock as young people to Zambia Airways hostesses and the people, when they go out, they bring beer, just beer. You had to do that. So we said, no, that was enough. That's why we are moving this. But it can be fine-tuned, and that's what we are talking about. Now, the measure that we have taken, there is no immediate direct relation to GDP, but the basic premise is that for any growth to be sustainable, you need to have a stable macro. What do we mean by that? It means that you have to have low and stable inflation. You have to have an exchange rate that is stable. You have to have a low and stable fiscal deficit. So if inflation gets out of line, then you are knocking on the macro instability. And the exchange rate in our setting has quite diverse implications. So if we don't address it, then it becomes a problem. Now, there are two ways, as we have noted, how you can address it. One is to put more resources in there, but that presupposes that you have the resources to put in. But if you don't, is to restrain demand. Now, what does that do? Which is the issue that Prudence has raised also, is that, yes, you see, for kwacha to go up, the exchange rate to move up, it means that there is supply and demand, right? That means there's someone has a kwacha to pay. When there is no kwacha to pay, it will stop moving. That's how it corrects. But for as long as people are willing, even if it's supposed to do that, it will continue. But some of those, as I indicated, are buying just to hoard, which deprives those who really need for business operations. Now, we have another phenomenon in our setting here where almost everybody now has become a trader in the foreign exchange market, where you are constantly looking at the exchange rate. Why are you doing that? Because how often do you buy? How often do you buy things? So that by itself is leading to some speculative things. Because when you go to a bank and say, I want some money, they don't have. They will go into the market looking for that. But you will not go just to one, maybe you go to another. Since they didn't give you, you go to another one. That one also going to the market. So suddenly you find that you are looking for 10,000, it has become 20,000. If you go to a third, you say, and now also they call that, it's like there's some more. So by the time that thing closes, the exchange rate has moved. Then now you see those who have the muscle who start telling you that, no, look, I think I have to peg it to the dollar. School, for example, they will tell you, no, now I think this is the price. Now, sometimes they will strike their own exchange rate. So look, no, this is not what is obtaining in the market. So I can't pay that. So you go into the market looking for that. So that's pent up demand we are talking about. So these are some of the things that go on in the market. And the exchange rate also plays on rumors. If someone said, no, I went to the bank, they didn't give me dollars. You incite someone now to start looking when they didn't have any intention of doing that, and the rate moves. So these are the things that we are trying to balance. But to your point of GDP, there are other factors which drive GDP other than this policy rate we are talking about. So that presupposes that one is getting money from the system here. It may not be that case. So we have to look at an extended period of time to see what it does. But our assessment is that 25 basis points, that's 0.25%, just to put it in perspective. See, yes, it's big if you are borrowing big, but if you are borrowing small, you won't even feel it. But that's the way it works. Now, Prudence raised a lot of questions. Yes, we did exactly what you are saying. But contrary to what you have said, I think it arrested the depreciation in the exchange rate. The issue you are raising about the economy going into recession had nothing to do with that. It was to do with the other factors. And in 2020, the economy went into recession, just like many other countries, because COVID hit him. So I think attribution of these has to be done very carefully, because you arrive at a different conclusion. Our assessment is that when you do this, it did arrest the runaway exchange rate. But don't forget, debt was getting out of hand, right? That's such that in 2020, we even defaulted, okay? So there were other factors which were going on, and the deficit was huge. What was happening? Much of the revenue which was gotten was going into debt service and the payment of salaries, leaving very little for other as issues. You saw the build-up in arrears. Many people were owed, including in the financial sector. That is the point you are raising, that they are downgraded, because when, as a civil servant, say you borrowed, there was an understanding that your pay will be deducted, that payment will be deducted at source. But you get your pay slip, it shows that the money has been deducted, but that money never went to the bank. So the bank now said, no, you haven't paid your due. So said, but I signed an MOU with the government. Said, yes, you did, but it's you who signed it, so you still liable. So that's the challenge that was there. So I hope you would look at the facts again. Then is what we are doing consistent with the idea of a private sector-led economy. This, what we are doing, is what they do everywhere. It's not strange in countries which are private sector-led. They do this. Why do they do it? Or why are we doing it? It's because there's a danger we are seeing coming, and we want to protect the economy from that danger, to put it simply. Because if we have runaway inflation, we have runaway exchange rate, even if we didn't raise the policy rate, there will be rupture in the economy. You will see, like I was answering to his question, the people not affording certain things, shortages will start emerging into the market. So that's why we're saying it's a balancing act. So some will move forward steadily, others may not. Then your issue of the TMTRF, I'm sorry to hear that you have not gotten the updated information. I think colleagues are listening. You have to go and look whether that is updated. That facility fully dispersed. I think the undispersed amount was just about 39 million kwacha, because the entity that had gotten approval could not come forward to draw that money, because they felt that they didn't need it in the manner that they had applied for. Because we are very concerned that when you get that facility, it must go to the intended purpose, and there must be visible benefits accruing to the borrowers of that money. Now, we had given a 1-year moratorium, which obviously has gone past, and indeed some of those are now being repaid. But the longer ones were up to 5 years, so they are still running, but they'll continue paying interest on those. So it's fully disbursed, and we have done an assessment of see where that went. 40% of that roughly went to the productive sector, which is a plus. This is what I was saying, that no, it's like once that ended, there's nothing to carry on. But that was supposed to help fill a gap and then move forward. So we have to continually, like DJ was saying, and the Frida in front of you was saying, to get this green thing. All those are efforts to get economic activity properly supported. I don't know if I missed something again. Okay.
Question from our online audience. Kindly shed more light on how much forex BOS is receiving from the mining sector. This is from Peter Chibale. The other ones relate, Governor, to issues that you have raised. Mr. Bernard Chewe is saying the ZIPA was against the issue of withdrawing liquidity from the economy through the instrument of the SRR. What is the bank's position on that?
Thank you very much. To Peter, the first question, I'll give you for 2 years, just so you get. In 2022, we got $1.45 billion. In 2022, the year that just gone by, we got $1.39 billion. You know, in the financial sector, we thrive on differences of views. You see, to get stability that you are talking about, you must have people who have different views. Because if you all think alike, you will not have stability. That's what we call herd behavior, if you all behave the same. So if they think, but in our assessment, we thought that was the instrument which was appropriate to use. So we would be happy to engage into a dialogue to understand what else would they have done in our circumstance. But I think in the secular, we did take time to explain what was happening. You see, the statutory reserve ratio, unlike the policy rate, the statutory reserve ratio actually addresses the balance sheet of the commercial banks. But the policy rate is on our balance sheet. So there is that distinction that is made. So the banks then, when they get that, they will have to be more efficient now on how they use the resources that they do. But it is effective in withdrawing liquidity. That's why we use it.
Thank you, Governor. One more question, which will be the last one from our online audience. The inflation rate is contributing to investors of government securities cashing out. Inflation averaging at 11% is frightening many of them. How do you actively curb the rate and encourage reinvestment in government securities? From Mukelebai Namatama.
Mukelebai, I think our understanding is slightly different from yours. That inflation at where it is currently hasn't deterred. In fact, if you look across the globe, many people actually have been praising the Zambia to say, how have you managed to get inflation to that level? Because inflation elsewhere has gone up more than that. In 2022, the target was single-digit inflation, and we closed at 9.9, so which was within target. And that was taking account of the various factors. Now, in terms of the foreign investors not participating, I think the point we are making is that these are worried that if they invest in government security and then you come that this is going to be part of the debt restructuring, what that means is that we are seeking debt relief, right? So which means that either they are going to have to face a haircut. A haircut is just a cute name of saying a discount. You know, you instead of say, like we are saying now here, it's 45% on the present value terms. That means that if you had lent to us 100 kwacha, you must knock off part 45 kwacha of that. That we just give you 55. So that's what they are afraid of. Now, this is deeper because you invest in order to reap the benefits. So that's the major threat to the non-participation of this, not the inflation. The inflation, that's a common figure, the variable they can look at, and they can hedge for that. If you look at where are the government securities interest rate yields, over 20%, look at inflation, 9.4. Surely that gap is so huge in terms of positive return. So that's not what we see as the factor inhibiting the participation of the other one I mentioned, and which we talk about in the statement and the presentation, is the debt restructuring, and particularly the threat that non-resident holders of that will be asked to also give a haircut. That's the major threat.
Thank you very much. So there we have it. We have come to the end of our press briefing. The Monetary Policy Committee increased the policy rate from 9% to 9.25%, up by 25 basis points.